Hello everyone and welcome you all to yet another informative session on finance current affairs, and today we are going to talk about the RBI master directions regarding the commercial papers and the non-convertible debentures. So before we start today's session, if you are preparing for any regulatory body such as RBI, Nabard or SEBI, you can definitely check out our exclusive offers on these courses. We have given various selections in the past and we are going to give in this year as well. So join us in this journey with Oliveboard. Apart from that, if you want to get the PDF of these particular sessions, you can go and join the Telegram channel as well. So let's talk about the context of this particular session, particular video. First, we'll talk about the background, like what led to these master directions, what all happened before these master directions. We'll talk about the drafts that were issued by the RBI. Then we'll go on and talk about the various definitions that are concerned with these directions. Let me tell you one thing, that these definitions will be really helpful to you in the objective based as well as the descriptive questions, because a lot many times we don't understand the meaning of a particular terminology, and this definition section will be really helpful for you. Then we'll talk about the eligible parties who will be able to invest and who will be able to issue these commercial papers and non-convertible debentures, guidelines, and later on we'll conclude with the reporting requirements. So this is going to be very important and very helpful session for your upcoming examinations. So do not skip even a bit of this particular video. Now, let's start with the historical background. Just kidding guys, this is not an history class. We'll talk about the background of the RBI. So in 2019, RBI announced a review on the money market regulations. Now let me tell you what is a money market first. Money market is a place where you can deal and invest into securities which have a maturity of less than 1 year. So if you're looking for a short-term investment, then money market is the best place you can have. We all know that in the capital market, you invest into equity which has a maturity of more than a year. At least I can say that, because the maturity goes from 2 to 20 to 30 years as well. So if you're looking for a very short-term investment, then money market is a very good place to you. Now, RBI has said in 2019 that they need to review the money market regulations, and for that they issued a draft, basically an experiment before they actually give the master directions. So on 4th of December 2020, they issued a draft for the market feedback to understand that these rules, these guidelines, and what feedback are we getting from the market and the various parties. So after understanding and reviewing all these market feedback, they have ultimately launched the master directions for the commercial papers and the non-convertible debentures, which will come into force from 1st April 2024. Alright, so this was basically just about the background, like what led to this particular master directions. Now we'll talk about the various definitions that are included in this master direction. Now let me tell you one thing and remind you again, these definitions will be really helpful for your examination. And let me tell you, if you understand all these definitions, the guideline and the actual core of this master direction would be a piece of cake. I assure you that. So don't skip this major part. First of all, the RBI has told about the definition of all India financial institutions. So basically, all India financial institutions are the significant financial institutions that lead a big impact in the economy, which include Export-Import Bank of India, which is the Exim Bank. Alright, then we have National Bank for Agriculture and Rural Development, also known as Nabard. We have National Housing Bank as well, and Small Industries Development Bank of India, and National Bank for Financing Infrastructure and Development. You should remember all the 5 names of the AIFI, All India Financial Institutions. So why they are telling about the All India Financial Institutions? Because you should think about it, that this might be the eligible investor or might be the eligible insurer for these particular securities, for the commercial papers and the non-convertible debentures. So you should have that approach while reading any master direction. When even you read a news, you should have that approach that if something is being stated in the starting of a particular draft or a particular direction, then it will have an implication in the future. So we will have to understand that part as well. Apart from that, the another definition is given for commercial paper. Now this is quite easy. If you are not able to understand the various money market instruments, then definitely comment that down in the comment section, and I'll definitely bring a video on the money market instruments. Like there are another money market instruments as well, like certificate of deposit, treasury bill, T-bills. So we'll talk about that as well. फिलहाल commercial paper we talk about, so it means an unsecured money market instrument issued in the form of a promissory note. So it is a short-term investment. It is unsecured. It is a promissory note, which is an IOU that I will give you this money at the end of this maturity period or at the end of the redemption date. So that is the commercial paper. The next thing is delivery versus payment. Now, delivery versus payment or DVP is a payment mechanism. Basically, it's a third party. So let's say I want to purchase some securities from the market and I'm giving the money and in exchange I want the securities back. So DVP will make sure that the securities are given to you till the time, or I should say, when the payment has been received from the investor. So then only the securities will be transferred to the demat account or the depository of that particular investor. So DVP means a settlement mechanism which stipulates that the transfer of funds from the buyer of securities is made simultaneously. In Hindi we say ek haath le ek haath de, basically that thing. So you are giving the money and in exchange you are getting the security, and there is a third party involved, which is the payment mechanism. So that is delivery versus payment, which is making sure that the securities are only transferred when the money has been received. Alright. Next definition they have given of a depository. So depository is basically a place, a virtual or digital place where you hold your securities in a digitalized format or a dematerialized format. So a depository company securely holds and stores the asset. And for this particular context, we are talking about the money market instruments or securities on behalf of the investors. So you don't have any place where you can hold your own securities. You have a demat account, but before that, you will have to hold the securities into a depository, and then later on these depositories will be transferred to your dematerialized account. So these institutions offer security, safety and administration services, maintaining ownership record. So these are really helpful organizations, and these are mandatory organizations if you want to deal in digital securities. So you will have to deal with them anyway. All right. So they help in the security transfer as well. The next definition they have given about a debenture trustee. Now, who is a debenture trustee? Basically, debenture trustee is a third party which has been, assigned to the debenture holder. As you can see, the definition says debenture trustee. So this is a trustee for the debenture holder who will make sure that the rights and the securities of the debenture holders are safeguarded. All right. So they are basically appointed by the company. So the company who is issuing the debentures, they appoint this person or a company who will be responsible for the debenture of the debenture holder, for the interest of the debenture holder basically. So it's a third party who secures debenture issues of a company's benefit, for a company's benefit. Definitely, if the debenture holder is happy, the company would also be happy. They have accomplished their goal of transferring the debentures to the debenture holder. So this is a debenture trustee. It's a third party. Again, very important to know, because you should think about it like this, that if something is being told in the draft or the directions, then definitely it will have some impact in the future. This party must be someone who will get involved in the transactions of the commercial paper or the non-convertible debentures. So we'll have to understand that as well. The next thing is financial benchmark administrator. Now, before we understand what is a financial or who is a financial benchmark administrator, we should understand what is a benchmark. A benchmark is basically a standard by which you compare things and you set prices if we talk about the financial environment. So basically, benchmark means the prices, the rate or the values or the combination of all the financial instruments that are calculated periodically, continuously, okay, and used as a reference point for pricing or valuation of financial instruments. So if today I want to issue some financial security and I want to set the price of the financial security, so I will have to look onwards to a benchmark, to a standard, that my pricing should be near about this particular benchmark. Either it can go high, either it can go low, but that will be as a reference point. It will be considered as a reference point. So basically, financial benchmark administrator is the person who controls the creation. That person is controlling the creation, how the benchmarks are being established, operation and the administration of these particular benchmarks. So that is a financial benchmark administrator. Again, it should light the bulb in your mind that okay, we are talking about a financial benchmark administrator. So definitely in the future, RBI would be telling us that the securities or the CPs and the NCDs price will be set according to the reference point of the financial benchmark administrator. That's the approach that we have to get, guys, if you want to really decode and understand and make it really easy to understand the current affairs and the circulations given by the RBI. Next thing is infrastructure investment trust. Now, what is an infrastructure investment trust? This is a very simple terminology. If you as an investor want to invest, or let's say if you as a company want that your income is based on the infrastructure, or the people who are pooling up or investing in your company are coming with the agenda to invest into an investment company, then that is an investment in infrastructure investment trust. Basically a pool of investors who are only targeting to invest in the infrastructure. That is an infrastructure investment trust. Sorry for that, guys. So these are a type of investment vehicle that allows investors to invest in the infrastructure projects. Now, recently we also saw that there has been a green rupee investment that has been issued by the RBI, which was talking about that the money in this fund, green fund, will be only invested in the eco-friendly projects or sustainable projects. So basically what this does is it accomplishes your I should say it accomplishes your idea or the need to invest, as well as it also give you that satisfaction of investing into a eco-friendly project or an investment project, infrastructure project. Okay, so this is a two-way thing, and this is a very concentrated fund or trust which is only investing into the infrastructure. So the main objective of this trust is to provide retail investors to access the investment opportunities in the infrastructure projects that were previously only available to large institutional investors. So you must all know that infrastructure is a very big sector, and only the big players and the big fishes were able to invest in these projects. But now with the help of a trust, you can pool in as an investor, and when very small investors and a huge amount of small investors come inside this pool, this actually creates a big investment, a big fund. And now you can invest this fund into any infrastructure project as per your desire. The next is real estate investment trust. Similar to the investment trust, real estate investment trust is only targeting on the real estates. So if you want to generate, if you feel like in the coming years the real estate market is going to boom, it's going to get high, and I should get benefit from this high. So basically you can invest in only the real estate investment projects. All right. So this can be described as a company that owns and operates real estates to generate income. So these companies are only concerned or only attached to the real estate, and I should say big real estates that are generating income, and this income is then further divided to the shareholders and the stakeholders in the form of income or in the form of dividend. All right. So real estate investment trust companies are corporations that manages the portfolios. Portfolios is the combination of high value real estate properties. So they have a pool of high value real estate properties, and they are generating income from these properties, and that profit is then distributed to the stakeholders. So for instance, they lease properties and collect the rent thereon. They're collecting the rent from that particular property, and this collected rent is later distributed among the shareholders as income and dividends. So again, one thing that we can understand from this is definitely a company who is going to issue the CPs and the NCDs, because if they want to generate their working capital, they want to generate and get the money for their operating expenses, so they can definitely go for commercial papers and NCDs. So these are not going to be the parties who are investing, because they are investing in the real estate, but these are going to be the parties who are issuing the commercial papers and the non-convertible debentures. So I hope you are able to get the approach that how we have to decode things in this particular directions. All right. Now, the next definition that they have given is of cooperative society. Now, in class 11th and 12th, if you are having a commerce background, you must know about this cooperative society. Like it's a group of people who have a common goal. That's basically a cooperative society. So it's an association of people who join together to protect and promote their economic interest, and I should say common economic interest. So few of the examples that you must have already know is Amul. Amul is not a company, it's a cooperative society. It's run by, it's run in Gujarat by thousands of basically women and men, and who are dealing in milk, and that was the actually the origin story of Amul. It was built as a cooperative society. Then you have Legit Papar, which is also very famous cooperative society, and then we have IFFCO, which is Indian Farmer Fertilizer Cooperative, again a cooperative society, which is created as a voluntary association to safeguard the interest and the common goal of a particular section of a society. All right. Now then we have the definition of an NBFC. What does an NBFC stand for? It's a non-banking financial company. As the word says, it's a non-banking, means that it is doing most of the things that a bank does, that is providing loans and deposits and everything. But what they are not doing is they are not coming under the umbrella of the banking regulations. So these are the financial institutions that offer bank-like financial services such as loan, investment, fund transfer, but without a banking license. So they are not subject to the same banking regulations and oversight as a traditional bank. As a traditional bank, they are not working like that. And NBFCs today they play a very big role in the market. Like originally they were started for the MSMEs, like to support the small medium scale industries. They were originally meant for that, but in today's scenario NBFC does play a very huge role in the economy of the country. Then we have limited liability partnership. You all must know what is a partnership, a combination or the partnership of two or more people who are going to work for a profit motive. All right, but the underlying assumption of a partnership, we think that they have unlimited liability. Now what is an unlimited liability? Unlimited liability says that even if tomorrow the firm is not able to pay off their debts, then the personal properties of the members of the partners will be at stake. So if you are creating a partnership, a normal general partnership at will, then in that scenario your personal properties are at stake. But a limited liability partnership says otherwise. It says that the liability of the partners are only limited to the extent of their stake in the firm. So how much you have invested in the firm, that's the only liability that you are going to suffer throughout your business. So it's a type of general partnership where every partner has a limited personal liability for the debts of the partnership. Your personal assets won't be at stake if you're not able to pay off your debts. That's a limited liability partnership. And again, another major party that might be included in the guidelines and the master directions by the RBI. Next is your related parties. Now, related parties is actually a group of people which is given under section 276 of the Companies Act 2013. So this is a very important thing that you should understand, that what is a related party and what are related party transactions. So related party is basically what? It's maybe the director or the person who is holding a key managerial position or his relatives. They all are coming under the basket of related parties, means they all are connected to each other. And in this context, a relative can be a husband, a wife, a son, a daughter, even a son-in-law, a daughter-in-law. So this is a very huge, I would say, scope of relatives. And these relatives won't and can't directly be indulged in the transactions with the company. Okay, so you should, I think you should get to know this and get to understand this easily, that if I am a director of a company and my relative, let's say my wife, wants to invest in my company or purchase securities from my company, then there are chances of insider trading. I can provide her the information that might benefit her and not the other investors. So therefore, related parties is a very important segment to understand any financial security, because they are excluded from investing in such proposals. So there is a huge list of the related parties. I would like you to have a look into it. And for this particular session, it's not really that important, but you should be able to understand that related parties are excluded from the transactions in and investment in the firm. So a firm in which a director or manager or his relative is a partner. So let's say I have a firm A and there is firm X, and then there is firm Y, and the director of firm X is also a partner of firm Y. So this becomes a related party, and they cannot indulge into direct transactions, okay, especially the financial securities. Or a private company in which a director or a member is a manager or a director. You get the idea that there are two companies, and a private company in which the director is also a member or a director of another company, or a public company in which the director manager is a director or holds along with his relative more than 2% of the paid up capital. So either it could be the person himself, or including along with him the relatives are holding a paid up capital of more than 2%, then that person also becomes a related party. Then anybody or any corporate whose board is accustomed to act in accordance with the advice of director or a manager. If a person is under direct influence of, and the decisions that are made by the person are directly connected with the director or the manager, so that is also becoming a related party, and it cannot, take part in any direct investments in that particular company. Or any person on whose advice a director or a manager is accustomed to act. Similar thing. Okay. So basically what I'm trying to tell you is that the related parties is a very important criteria for understanding these master directions, because ultimately you get the idea that they will eventually be excluded from taking part in the investment of commercial papers and the NCDs issuing enterprises. Alright, moving on to the next definition, which is your money market instrument. Now, money market instrument, as I told you earlier in the starting of the session, it's a short-term financial security market, which are highly liquid and considers low risk. Although they are safe, they are having a low risk, they are safe, but the interest rate is also less than as compared to the capital market, and the benefit also is less as compared to the capital market. But the good thing and the pro is that it is a short-term investment criteria, so you can invest into it for like within a year, you can get the money back, and it's highly liquid. So whenever you want to convert these securities into cash, you can do it like in a few days, or in fact in few hours, if you get the concerned party. So these are easily converted into cash and have a maturity duration up to 1 year. So the maximum maturity of this particular instruments can extend up to 1 year. Now, there might be a doubt in your mind that non-convertible debentures, or when we talk about debentures, to be precise, then they are considered under the capital market, because we talk about capital market, we talk about equity and debts, and debts meaning debentures. But the RBI has strictly and clearly defined that we are talking about the non-convertible debentures who have a maturity up to 1 year. So please don't confuse this with the traditional non-convertible debentures. Right now in this particular session and in this particular directions, we're only talking about the non-convertible debentures who have a maturity period of less than a year. So it does not include the NCDs who are having a maturity of more than 1 year, 2 year, 20 years. There are some NCDs like that also, but this particular session is only concentrating on the NCDs which are having a maturity of less than 1 year. Moving on to the next definition, which is non-convertible debentures. I just told you about the non-convertible debentures. To be more precise, these are debentures and securities which cannot be converted into any other form of security. So you cannot convert this debenture tomorrow in equity or in terms of preference share or any other security. These will hold their position and hold their form forever, and their maturity will have only up to 1 year. So they have the maximum maturity of 1 year, and within 1 year you will have to redeem and pay the money back to the investor. The next definition they have given of is over-the-counter market. Now, over-the-counter market are not like your traditional stock exchanges like NSE or BSE, but these are the where the transactions are taken other than recognized stock exchanges, and they include your ETPs, which is electronic trading platforms. So you must all have heard about companies like Zerodha. So Zerodha is an example of electronic trading platform which is different from your traditional stock exchanges such as NSE and BSE, and you can buy and sell your securities in this over-the-counter market as well. Now, after understanding all these definitions, we will talk about the eligibility of the CPs and NCDs which have been mentioned by the RBI. Now, who are the parties which can actually invest into this, and who are the parties which can actually issue this to the public? So, eligible issuers, the people who can provide or issue the CPs and the NCDs in exchange of the money to get their capital or working capital, or to get their operating expenses covered. So either a company a private or a public company, and company is defined under the Companies Act 2013 section 2. So you can have the definition of the company from there, but in simple terms, a company can issue your CPs and the NCDs. Apart from that, any financial institution, not any, only three types of financial institutions. An NBFC can issue, including housing finance companies. So we have already talked about the non-banking financial companies. They can issue the CPs and the NCDs. All India financial institutions, which consist of 5 institutions, which we talked earlier in the session. So you can see how those definitions were able us to decode these directions in a very easy manner. So those 5 institutions, apart from that, NBFC, and the third is your infrastructure investment and real estate investment trust. So we talked about those 2 companies as well. The companies who are investing only in the infrastructure projects and the company who are investing only into the real estate projects. They can also issue the CPs and the NCDs to get money from the public. Apart from that, any other large organization, now they have defined what is a large organization. Any body corporate with at least 100 crore of net worth. So the minimum net worth should be of 100 crore, and it is able, and after that it is able to borrow the money in the form of CPs and the NCDs. And as is specifically allowed by the RBI, now this is up to the discretion of the RBI. To any organization that the RBI says can issue, they can issue the CPs and the NCDs. Alright. Then we have any cooperative society or LLP which is having at least 100 crore worth net worth. Okay, so you can understand this now. We talked about all the definitions of the various institutions from NBFCs to cooperative society and LLP. Now the RBI is stating that what all cooperative societies and LLP can issue the CPs and the NCDs. So who can issue? Any LLP or cooperative society which is having a minimum net worth of 10 crore. Apart from that, any large organization having a minimum net worth of 100 crore. Sorry if I said 10 crore previously, it was 100 crore. And then we have financial institutions which include the NBFCs, All India Financial Institutions, and the investment, infrastructure and real estate investment trust as well. Alright, now let's talk about the eligible investors who all can invest their money into the commercial papers and the NCDs. Now, not everyone, although they have given the definition in such a way that everyone is included, but except the related parties. Now, I told you this previously as well, that related parties are exempted from issuing or investing into the securities which are issued by their related parties. So if I am issuing any kind of a commercial paper or an NCD, then my wife or my son cannot invest into that particular security. Basically that. So all are eligible. All residents. Now these residents will include the individuals, companies, as well as any other organization. It is not concentrated till the actual human being. In the definition and in the law, we talk about that a person can be anything. Okay, there are artificial persons as well which do not have a physical appearance, but they have an entity as per the law. So any non-resident as well. Now for this they have given that it is given into the FEMA, Foreign Exchange Management Guidelines. You will have to go through that, not that much important, but basically everyone is included in the eligible investors except the condition that no resident or non-resident can invest in CPs or NCDs issued by the related parties. That I have clearly made you understand that who are related parties and who all cannot invest in this particular CP and NCD. Alright, moving on. Let's talk about the issuing guidelines. Now, this particular guideline is given for the issuance of these CPs and NCDs, like in what format can you issue them, what's the minimum and the maximum limit, what's the maturity for CP and what's the maturity for an NCD. About that we'll talk about. So first thing is that it should be dematerialized. We live in the 21st century, guys. We all know that the securities now don't have to be in the physical format. They can be in the digital format as well. But in this particular direction, they have strictly said that it cannot be in any physical format. It is supposed to be in an electronic format, which is known as dematerialization. which is the conversion of a physical security into a digital security. So both the CPs and the NCDs should be in an electronic format. Apart from that, the minimum investment should be in the denomination of 5 lakh, meaning the least amount of investment that an investor can do is of 5 lakh, and it is supposed to go in the multiple of 5 lakh. So either you can do for 5 lakh, then the next investment will be for 10 lakh, then 15, then 20. It cannot go like you can invest for 6 lakh. That cannot happen, because you can not break down the security into, decimals. So you will have to invest either in 5 lakh, either in 10 lakh, either in 15 lakh, and so on. The maturity has been clearly defined for commercial papers and NCDs. It is saying that the commercial papers will have a least maturity of 7 days to 1 year. Meaning if I invest today, after 7 days I can redeem, I can get the money back, or after 1 year I can get the money back. But actually it's exactly 1 year, not after 1 year. The NCDs have a maturity of 90 days to 1 year, so they can have a redemption period. You can get the money back after 90 days, and between 90 to 1 year, 365 days, you can get the money back. The next guideline is that there should be no underwriter. You must know that when a company is issuing an IPO or selling its securities, equity in the market, they need brokers. They need person who can go and sell these securities to the general public. But for the CPs and the NCDs, the RBI has said that there should be no middlemen. Issuers cannot use underwriters or co-acceptance. They cannot go for a broker and sell the securities to them, and then they will later on sell the securities to the general public. That's not possible. You will have to directly sell it to the investor. Then there is a disclaimer. You will have to offer documents must include the specific disclosures. Now there are specific disclosures which are given in the Annex 1, that what all things have to be transparent. So those informations you will have to specify, and to the investor as well as to the RBI. Then we have settlement. Settlement means the whole process of issuing the security and payment of the money should be done in T+4 days. So that's the payment cycle for primary market. I should clarify you that this is the cycle for the primary market. If you are investing for the very fresh CPs and the very fresh NCDs, but if there are existing CPs and NCDs in the market, the settlement period goes lower. Okay, so for the fresh securities, for the fresh CPs and the NCDs, the settlement cycle is of T+4 days. I hope you understand what is T+4 days. T is actually the transaction date, the date on which the execution happened, and +4 working days. I'm not including holidays between that. The working days +4 will be included in the T+4 days. So basically, if on Monday the transaction has happened, then Tuesday, Wednesday, Thursday. All right. So +4 Friday. This will be the date of settlement, like till Friday, and they have also specified the time, like how much at what time till Friday. So till Friday you will have to complete the whole settlement. The securities should be transferred to the investor, and the investor should have paid the money back to the issuing company. Then there is individual limit. Now individuals, including HUF, can have a maximum 25% of the total issue. So if you are going to issue and you want to issue in the CPs and the NCDs, then the maximum that you can invest into is 25% of the total investment. So basically, if 100 CPs have been issued, a particular single individual, and HUF including, can only invest 25 in the securities as well. They can only purchase 25 out of the 100 securities which have been issued in the market. I hope that was pretty much clear. This is very important for the examination as well. Like, you can expect multiple questions from these information, and definitely at the end of the session I will give you few questions for homework, and you will have to give the answers in the comment section as well. Okay. The next thing is your discount and coupon rate. You should know that the money market instruments, they are either issued at discount and then redeemable at par, meaning that if a security is having a face value of ₹100, so what a company can do is it can issue the security at 90 rupees and then redeem the security at 100 rupees, meaning that they will get 90 rupees from the public, and while returning the money back to the public, they will have to pay 100 rupees. And this 10 rupee is basically the discount, which is a profit for the investor, because he's receiving 10 rupees more apart from the principal amount. or the coupon rate. Sometimes, coupon rate is basically concerned with the NCDs because NCDs are issued at coupon rate and interest rate. Whenever you read a debenture, if you remember and reminiscence the class of 12th, you will remember that whenever questions used to come, it used to say 12% debenture or 10% debenture. So basically this 12 or 10% is the coupon rate, the interest which the particular security is holding. So regarding that, what the RBI has said, we will try to understand that. The commercial papers shall be issued at a discount to the face value, which is quite simple. That if you are issuing commercial papers, it should be issued at a discount, meaning at 90 rupees you will sell it to the public and you will pay the public 100 rupees back while redemption. Okay, they're not clearly specified that in redemption you will have to do at par, premium or discount, but we are assuming that you will have to pay that in the face value. 100 rupees you will have to pay back to the public. The next thing is that the NCDs shall be issued at a discount. The non-convertible debentures can also follow the same format. They can be issued at a discount of 90 rupees and then redeemed at a price of 100 rupees, or by the traditional way. If you want to give the coupon rate, then it could be fixed or floating coupon rate. Either it could be a fixed coupon rate, which is giving you a fixed amount of income like 10%, 5%, 20%, that is fixed in nature. Or it can be a floating rate, which will change from time to time. Now, here comes your financial benchmark administrator that we talked about earlier. The benchmark, the standard which is set according to which it is taken as a reference point for the other parties to set their prices and set their coupon rate. So what happened here, that the coupon on floating rate, fixed is pretty much genuine. You will give the fixed rate as per your convenience. But if we talk about the floating rate, that floating rate will be matched, will have to be linked with the financial benchmark administrator. So whatever prices they are giving, you will have to match that coupon or that floating rate, or any rate which has been approved by the Fixed Income Money Market and Derivative Associations of India for this purpose. So basically, for the floating rate, you will have to refer to these two organizations. All right. Now, next is your credit enhancement. Credit enhancement basically means the help you can help you can provide to the investor, or in the case of default, how you will repay. So for banks and all India financial institutions, they have said that they can offer, I'm repeating it again, it's not mandatory. They can offer support to the issuers. How? To the investors. How? They can provide standby assistance or credit, and standby assistance is a backup if the issuer cannot pay. So if the issuer, the company is not able to pay back the people or the investor, they have a backup plan or a backstop facility. A backstop facility is basically the lender of last resort for the investors. So it is a guarantee that the payment will be given to the issuer if the issuer defaults. So if the issuer or the company is not able to give the money back to the investors, then they will have a backstop facility which will guarantee them that the money has been paid. But this is an option. This is not mandatory to provide such guarantees. Then there is non-bank entities. For non-bank entities like a company or an LLP or a cooperative society, they can provide unconditional and irrevocable guarantees. Now these are very tough words. These are very heavy words. Unconditional and irrevocable guarantee basically means that you will have to pay the money back anyhow. Okay, for the CPs and the NCDs issued by the company. So this is not mandatory. This is basically optional. They can do this. Next is your end use. End use basically means that how this money will be used by the issuing authority. So let's say that an LLP wants to generate money from the CPs and the non-convertible debentures. Then the RBI in these master directions have specifically specified that this money will be used for such and such purposes only. And if you go out of this box, then you will have to give proofs, and you will also have to notify that you are using this money for any other purposes. Now, traditionally, whenever you are issuing from short-term investment, it is a general rule that short-term investment should only be able to, cover the short-term liabilities only. So for paying your salary to your employees, or for paying the rent, for paying any operating expenses, such expenses are covered with the help of short-term instruments. So usually financing current assets, you can buy inventory, raw material, tools with this particular money, or you can use it to cover the operating expenses such as rent or salary. But if for any other purpose, it is allowed. It's not that you can only use it till your salary or your current asset. But if you go through that, then you must clearly state exactly how the money has been used in the offer document. So while offering, which is known basically sometimes as a prospectus or a brochure, so in that particular document you will have to specify that okay, we are asking the money from the public and this money will be used for so and so purposes other than your salary, operating expenses and current assets. So you will have to verify that, and you will have to specify that, and to verify that you will have to go to the CFO and the CEO. So after raising the money, you will have to provide a certificate from your CEO and CFO to the authorities. Now the CEO and CFO will eventually authenticate that the money has been used for so and so purposes. So this particular certificate will have to be submitted when? Within 3 months of raising the money, or when it matures, whichever comes first. So either after 3 months of raising money or when it matures. If it matures before 3 months, if the maturity period is less than 3 months, so you will have to notify then. Else you will have to notify and provide the proof that you have used this money for so and so purposes at 3 months, after 3 months of issuing the money, or before 3 months if the maturity is within 3 months, whichever comes earlier. Alright. Now the next thing is about rating requirement. How the securities and what's the minimum security, minimum credit rating for these securities. Now you should understand that the credit rating agency, there are various rating agencies all over India and globally. They provide rating to particular financial securities like AAA, BB, A plus, A minus. These are basically the ratings of a financial security, which gives you the idea that how safe these securities are. So the minimum credit rating, they must have a minimum rating of A3. Alright. Again, a factual thing that you will have to keep it in your mind, that the CPs and the NCDs should have a minimum credit rating of A3. And this rating should be specifically given by the SEBI registered credit rating agency. Not any Tom, Dick and Harry can provide this rating. You will have to get this rating from the SEBI registered credit rating agency. Clear? Now, what does A3 means? Now, A3 is not a very safe, it's a moderately credit risk, which means that there is a possibility of default, but the issuer is generally capable of meeting its financial obligations. Okay, so these are moderately risky, not that much risky, not that much safe, but there are high chances or moderate chances, I would say, that your money will be given back to you. Now, this is the minimum credit rating. It can even go higher depending on the company and depending on the security as well. Okay. Now, for primary market, what are the guidelines? Now, if you want to issue in the primary market, you are issuing the CPs and the NCDs first time in the market. What are the guidelines for that? A special advisor, which is known as issuing and paying agent, an IPA, must be hired for every CP and NCD issuance. Now, this IPA is actually a person who will make sure, a third party who will make sure that the issuing has been done and the payment has been done. Issuing has been done by the issuer and the payment has been done by the investor. For NCD and for NCD only, a debenture trustee is also required. This is very easy to understand and remember, that NCD is a non-convertible debenture, and for that an additional person or authority will be appointed, which is known as a debenture trustee. Now, what is a debenture trustee, don't you ask me? We already discussed about the debenture trustee previously in the definition section. That's why I was telling you that these guidelines will be really easy to understand if you get through the definitions very clearly. Alright. So debenture trustee is a third party which will make sure that the interest of the debenture holder is safeguarded, and he is appointed by the company or the issuing company. Alright. For secondary market, now there is two options. Okay. Either you can go for over-the-counter market or any stock exchange which is recognized by the Reserve Bank of India, like NSE, BSE, any other all stock exchange. You can either go there. In secondary market means the existing securities which have already been sold in the market and now they are floating from one investor to another. So you can purchase them from the over-the-counter market or any market, secondary market, which has been recognized by the RBI. Now, the settlement period for the secondary market instruments or in the secondary market is either T plus 0, which is the same day on the transaction date itself, you will get the money back and you will get the money and you will transfer the security to the investor. All right. Or the next day, which is T plus 1 after the trade. The next day after the trade, you will have to make sure, the IPA has to make sure that the issue has been done and the payment has already been received. Okay. So I just want to throw some light into this. In the primary market, the time period is for T plus 4 days. The settlement should be done within T plus 4 days. But for secondary market, it's way less. It should be T plus 0 days, which is the same day, or T plus 1 day. Clear? Now, the settlement method. How will the securities be transferred? How will the money be received by the issuer? That they have told. For CPs, commercial paper, they are saying that the DVP method will be used. DVP method, we already talked about this. A mechanism, a payment or settlement mechanism where the money is only transferred when the securities have been issued and received by the party. So this only happens after the CP is delivered. Once the CP is delivered, the payment will happen. It happens simultaneously, okay? But for NCDs, it can be either bilateral or it can be DVP. Bilateral means there would be any third party included. The buyer and seller directly will exchange the payment and the NCD. This is for only the NCD, okay? But they can also go and follow up the DVP method or mechanism as well. So the main thing is, for commercial paper, it is confined only till DVP. But for the NCDs, they can either go for bilateral settlement, which is not including any third party, or they can go with the DVP mechanism as well. Then they have talked about the buyback. Now, what is a buyback? Sometimes what happens when a company or when an issuer issues the securities in the market, but because of overflow of cash, they want to reduce this overflow of cash and, optimally utilize the overflow of cash. They can buy back their own securities from the market. In such way, because you understand the demand and supply procedures, because if a company is buying back again its securities, so the supply of the securities in the market will lower down, and as the supply will get lower down, the prices of the securities will get high. Okay, so that's what happens when a company is buybacking its securities. It can be shares or security, any other security as well. The core understanding is same. Now, what they have told about the buyback. Issuers can buy back. A company, once they have sold their securities in the market, they can buy those securities again from the market. But they have to wait 7 days after the issue for commercial papers and 90 days after the issue for non-convertible debentures. It's not like that today you issued these commercial paper and tomorrow you are saying I want it back. No, you will have to wait for at least 7 days for commercial paper and at least 90 days for NCDs before you buy back these securities from the market. Now, this offer must be same for all investors holding that specific CP and NCD. Now, again, this is also on the discretion of the investor, the person who is holding the security, that does he want to sell it back again or not. So this should be same for every investor, be it any resident, non-resident, it does not matter, company or an individual. They all should have given the same right that they can sell back to the organization. But investor can reject or accept this particular offer as well. They can accept that they want to sell it out and they can reject that they do not want to sell it back to the company. But the price, the main thing is that the buyback price is the current market price, not the original issue price. So if you have issued it at 90 rupees and today the market prices are of 95 rupees, so the company will have to buy back these securities at 95 rupees, not 90 rupees. Payment should be done through an IPA, which is an issuing and payment agent, and once bought back, they are cancelled, meaning they cannot be again further sold in the market. They will cease to exist. These securities will no longer be sold again in the market. So it's a one-time opportunity only. Now, talking about the repayment of CPs and NCDs, we talked about the issuance. We talked about the settlement. Now comes the maturity date, the date of redemption, when the securities are, taken back from the investors and the money is given back to the investor. there should be no grace period. Basically, grace period is a date extension, a liberty that you can pay the money not on the maturity date but after 3 days or after 4 days. Like when we study bills of exchange, we learn there that the maturity date is not the date of redemption but 3 days after the date of redemption. So you will given a grace period of 3 days, but here it does not happen like that. You will get your money back. Like, this is talking about the investor. The investor will get the money back on the maturity date. No delay is allowed. And the time is also mentioned. It should be given back by 3 p.m. of the maturity date. So let's say today is, let's take Friday. So if the maturity date is falling on Friday, so by 3 p.m. of Friday, the money should be transferred back to the investor's account, and payment will be done through the IPA, which is the issuing and the payment agent. So it's kind of a middleman who will make sure that the payment has been done back to the investor. Now, we talked about the repayment, but we don't live in a perfect world. It is possible that the repayment is not done and there is a default. The company is not able to pay back the money. Now what will happen? They must notify the authorities. It should be notified that they are going to do the default by 5 p.m. of the default date. So they will have to inform the IPA and the Debenture Trustee. In the case of NCD, you know that for CPs they have a IPA and for NCDs they have a Debenture Trustee. So they will have to be informed by 5 p.m. of the default day that the money won't be able to pay. Alright. Next thing is public announcement. They will have to announce this in the company's website, meaning total public humiliation. Then they have repayment option. If the repayment can be done directly by the issuer or through the IPA or the trustee. So basically what it's trying to say is that if you are not able to pay off the full amount, you can pay the partial amount as well. So default is something which can be total default or it can be a partial default. You are not able to pay even a single penny, or you are able to pay some amount of the investors. So if there is a partial payment, then it will be paid proportionately. Proportionately means the money available with you and the proportion in which the investor has applied for. So let's say the proportion is coming 3:1. 3 is basically the investment and 1 is basically the amount left. So if the investor has invested 3 lakh or he is due 3 lakh, then he will be paid 1 lakh rupees. That's basically proportionately. Then the conversion after default. If default has happened and they want to convert these securities into any other security, they will have to, the original instrument is considered extinguished, meaning that the previous security will cease to exist. And the last is ban on new issuance. If a company has already defaulted and has not been able to pay the money back to the investor, they won't be able to issue any new CP or NCD until the defaulted obligation is fully repaid, until the full payment has been paid back to the investor. Else, they will have to wait for 6 months, whichever comes earlier. So if they are able to pay back the investors within 5 months, they can do or issue new securities after 5 months. But if not, then after 6 months, anyhow, they will be able to issue the new securities, the new CPs and NCDs in the market. Coming back to the last part of this particular session, which is reporting requirements. Now, all this have to be reported to the RBI or any other party, that how the issuance have been done, how many CPs and NCDs have been sold, how many buybacks have been done, default, and everything will have to be reported to any authentic party. So that we'll talk about. And before that, we should understand the authentic party's name, which is the Fixed Income Money Market and Derivative Associations of India. And it has a platform which is known as the FTRAC platform, which is Trading, Reporting and Confirmation System. So this platform will be a very easy to use tool for the investors to know about the know-hows of all the securities, that how much have been buybacked, how much have been defaulted, how much have been issued, at what prices. Everything will be reported in this particular platform. So it is a reporting platform for transactions in specified instruments, and for our case it is CPs and the NCDs. It is used to capture and report trades in the secondary market. So for our case, it's not only secondary market but also for the primary market, the reporting will be done in this particular platform. So first we'll talk about the primary issuance. Now, let's have a quick recap. The primary issuance of the CPs and the NCDs is done by the IPA and the Debenture Trustee respectively. CPs are guided under the IPA and NCDs are guided under the Debenture Trustee. So here, who will report? First, the issuing and placing agent will report. Where he will report? He will report it to the FTrack platform. What he will report? He will report the details of all the new issuances of the CPs and the NCDs. How many CPs by what organizations have been issued and how many of the NCDs have been issued. They will have to be reported in the FTrack platform. And they have also stated the time by which they have to report. So it's 5:30 p.m. on the date of issuance. So whenever the date of issuance is happening, the date of execution is happening on that date, by 5:30 p.m. they will have to report that and report that into the FTrack platform. The next is for secondary market transactions. Now, because in secondary market transactions, IPA and debenture trustees are not involved, the investors are directly involved. So these investors and issuers, each counterparty of the transaction, the person who is selling the security and the person who is paying the security or buying the security, they will have to report it on the FTrack platform. When? They will have to report it within 15 minutes of execution. Execution means the time at which the price have been setted. So from that time or time of execution, within 15 minutes, they will have to report it to the FTrack platform. And the information, what information? Same information about the CP and the NCD trades, including the OTC and exchange transactions. At which OTC, over the counter market, have you exchanged them, or any secondary market that you have exchanged that. You will have to provide all those information in the FTrack platform. The next reporting relationship or requirement is for buybacks. Again, buyback is what? It is purchasing back your security from the market. This will have to be reported by the IPA again on the FTrack platform by 5:30 p.m. on the buyback date, and they will have to pay or show the details of all the CPs and the NCDs which were buyback and at the prevailing price. So you should know that the buyback is done at the current market price, not the issue price. So they will have to note it and report everything in the FTrack platform. Last, and this is your default. In case of default, what will happen? So in case of default, the IPA will again report in the FTrack platform. Now I would like to throw some light into it. If you remember, when default was happening, I told you earlier that at the time of default, the IPI will be, or I should say, let's say this is the company who is issuing the security. They will have to report to the IPA by 5 p.m. of the default date, and then IPA have to report this into the FTrack platform by 5:30 p.m. of the default day. So don't confuse with the time and everything. IPA will report to the FTrack platform by 5:30 p.m. means he will get half an hour of time to report this into the FTrack platform. He will report the default and the repayment of defaulted obligations. Either it is partial or 70%, 30%, whatever the case may be. They will have to also provide that how much repayment has been done by the issuing party. Okay, then we have depositories and debenture trustee. So for depositories, they don't have to go into the FTrack platform. They will directly report it to the RBI. So depositories will have to report to the RBI fortnightly, meaning every 15th and 30th of each month, or requested by the RBI. They will have to tell them the details of all the dematerialized CPs and NCDs held with them. If you remember the first guideline of issuance, I told you that all the CPs and the NCDs should be in a dematerialized format. So the depositories are the parties who are doing this work, and they will have to report it every fortnight to the RBI that how many new CPs and NCDs have been reportedly registered under their platform. And the last is your debenture trustee. Now, debenture trustee is only for the non-convertible debentures only. They will also report to the RBI, but via mail. They will provide this information with mail, and they will provide it quarterly, like within 15 days of every quarter ends. So whenever the quarter is ending, within 15 days of that end date, they will have to provide the information about the outstanding NCD amount and details of NCD default. So you know, debenture trustee is the person who is working for the interest of the debenture holder. So if any default has been done, or if there is any outstanding amount for the NCD, then that should be reported by the debenture trustee to the RBI with the help of a mail. So guys, this was basically the whole master directions of the RBI on the CPs and the NCDs which are having a maturity of less than a year. Now from this information you can solve and get few questions in the examinations, and I would really like that you solve these questions yourself, comment them in the comment section, and definitely then verify your answer. So I'll do 2 questions for you and 2 questions are going to be your homework. How long does it take to settle the primary issuance and a receipt of funds for CPs and NCDs as per the master direction of Reserve Bank of India regarding CPs and NCDs which are having a maturity of 1 year, which was given on January 2024. So guys, you might get confused about this because we have 2 settlement period. We talked about primary and we talked about secondary. So this is question regarding the primary issuance. So I hope everyone was able to give the answer. It should be done within T plus 4 days. So the answer would be option number D, T plus 4 days. Alright, the next question is that what is the maximum investment limit for an individual including HUF in a single issue of CPs or NCDs? So we also talked about the maximum limit, how much an individual can issue. We talked that of the total investment criteria, only 25% should be in the hands of a particular individual. So the answer would be the maximum limit is 25% of the total issue. Alright, so these 2 questions, this question that you can see on your screen right now and this question is going to be for your homework, and definitely I'm looking forward for the comment on the comment section. So do like and subscribe and support this channel, and if you guys are preparing for the RBI examinations, then definitely you should go and check out our exclusive courses on the concerned examinations. This was me, Divyanshu, and I hope the session was really helpful for you guys. I will see you guys in the next session. Take care. Goodbye. Jai Hind.